Welcome to the Deep Dive.
Yeah.
Today we're tackling something absolutely essential if you're buying or selling a home, the closing process. And it's not just, piles of paper.
Not at all.
Think of it more like a grand orchestration, or maybe a precision landing for your whole real estate deal. Everything has to line up perfectly.
That's a great way to put it. And the conductor of this whole thing, that's your escrow holder, this neutral third party who's absolutely critical. They make sure every piece fits right when it needs to.
Yeah, and that's our mission today in this Deep Dive, to really demystify this stage. We want to show you how all these moving parts, the money, the paperwork, the people come together with, well, incredible precision.
Right, because understanding how it works helps make sure it goes smoothly for you. A successful closing really hinges on this precision.
We've got our usual stack of articles, guys, all sorts of notes here to guide us.
Yep, let's dive in.
Okay, so let's start with the conductor, this escrow holder. What exactly is escrow, and who is this person?
Okay, so fundamentally, escrow is a process. Think of it like a secure holding area. A neutral third party steps in, holds on to the money, the buyer's deposit, the loan funds, and the crucial documents, like the deed. And they don't let go of anything, not the money, not the deed, until every single condition laid out in the sales agreement is met by both sides.
So they really are neutral. They're not working for the buyer, not for the seller.
Exactly. Purely neutral. They're the trusted go-between. And yeah, you hear different names for them: escrow holder, escrow agent, settlement agent, sometimes stakeholder.
Got it.
But their job is always the same: protect everyone's interests, buyer, seller, even the lender. They make sure promises are kept before the keys and cash change hands. It's like they're holding the vault door shut until everything is perfectly in place.
And here in California, these aren't just random folks, right? Independent escrow companies have to be licensed and regulated.
That's right, by the Department of Financial Protection and Innovation, the DFPI. And that oversight is really important, especially when you hear about some of the stuff we found in the sources.
Oh, like what?
Well, it turns out these licensed escrow companies, because they handle huge sums of money right at these critical moments, they've become major targets for some pretty sophisticated scams, particularly social engineering.
Social engineering. Oh, okay, that sounds kind of intense. Like hacking people instead of computers.
Pretty much. The sources specifically mentioned phishing attacks and, even scarier, business email compromise, BEC. These aren't about breaking through firewalls, they're about tricking people, manipulating them psychologically to give up info or, worse, wire money to fake accounts.
Wow. Is there like a specific example of this happening?
There was a really stark one in the sources, yeah. A licensed escrow company in California lost almost $2 million, it was. Well, the source described a fraudster calling the company, pretending to be from the bank's IT department.
Oh.
Yeah. They convinced someone there to grant them remote access to the company's online banking. Then, bam, internet connection gets cut. By the time they got it back online, the scammer had already initiated a bunch of wires. Nearly $2 million gone from trust and general accounts.
$2 million. Just like that.
Just like that. The company couldn't stop all the wires, couldn't cover the shortage in the trust account, and ended up having the DFPI take over as conservator. Yeah, it's serious stuff.
That really hammers home the safeguarding funds part of their job. It's not passive holding, it's active defense.
Absolutely. And these scammers are clever. They'll impersonate anyone: the buyer, the seller, the agent, even the escrow officer. They often slip in fake wire instructions right at the last minute, maybe using emails that look incredibly legit.
So what can companies even do about that? How do they fight back?
Well, the sources mentioned some countermeasures, things like requiring any changes to wire instructions to be notarized, adds a physical check,
Right. Harder to fake.
Exactly. Or proactively calling the client at a number they already know is good to verbally confirm wire details before sending anything. Plus, just putting big, bold wire fraud warnings in emails, constant reminders to be careful.
It sounds like a real cat-and-mouse game.
It really is. And the DFPI gets involved too, investigating these things, requiring companies to report scams or shortages immediately. It just underscores how crucial it is to pick a reputable, licensed, regulated escrow provider. They're kind of your financial bodyguard in the transaction.
Okay, so we've got our conductor who's also doubling as security. What about the actual music, the instruments, and the sheet music, so to speak?
Right. That takes us to actually setting up the escrow and the key documents involved. So once the buyer and seller sign the purchase agreement, that's when escrow is formally opened. Now, both that purchase agreement and the escrow instructions you give the agent later, they're both contracts, legally binding.
Yeah.
And they have to be in writing.
And they work together, right? The sources mention them working in tandem.
Yes, exactly. Think of the purchase agreement as the main theme, price, timeline, big conditions. The escrow instructions, that's the detailed sheet music for the conductor. It tells the escrow agent precisely how to handle the money and documents based on that main agreement. They have to match up perfectly.
So what are the first few things people need to do once escrow is open? Any immediate actions?
Yeah, a couple of key things right off the bat. For the seller, you need to give the escrow holder all the payoff info for your existing mortgage. Lender names, addresses, loan numbers, all of that.
Okay.
And this is important because some lenders, the sources mentioned FHA specifically, might need like a 30-day advance notice for a final payoff quote. If you don't give them enough notice, you could end up paying extra interest or fees. Nobody wants that.
Definitely not. What about for the buyer?
For the buyer, a really critical early step is deciding how you want to take title to the property. This is how your ownership gets legally recorded, and it has big implications down the line.
And the sources were pretty emphatic about who should not help with that decision, weren't they?
Oh, absolutely. This is a huge takeaway. The sources basically shout this. Your real estate agent, your broker, even the escrow officer, they should not be advising you on how to take title, period.
Why the hard line on that?
Because it's a legal and tax decision, plain and simple. Choosing how you hold title affects things like inheritance, taxes, liability. It's complex stuff. The sources say you need independent professional advice. Talk to a qualified lawyer or a tax advisor. Your agent can explain the options like joint tenancy or community property, but they can't tell you which one is right for you.
That's a super important distinction. Could save people a ton of trouble. Okay, so instructions are given. The sheet music is ready. What's next in this precision landing?
Next up is checking the harmony of the property itself. This means the main evaluations, the home inspection, and the appraisal.
Right. The inspection is where someone goes through with a fine-tooth comb.
Exactly. The inspector is like your quality control check. They're looking for any issues, roof problems, plumbing leaks, electrical issues, structural concerns, stuff that could affect the value or just be a headache later.
Mm-hmm. And the appraisal, that's different.
Yeah. Yep. The appraiser's job is to figure out the property's current market value. They look at the location, size, condition, recent sales of similar homes, nearby comps,
Got it.
And these reports are vital. They help both the buyer and seller understand the true condition and fair market value. No big surprises, hopefully.
And that appraisal value is especially crucial if the buyer's getting a mortgage, I imagine.
Absolutely essential. The lender won't lend more money than the property is actually worth. So if that appraisal comes in lower than the price you agreed on, well, that can cause a hiccup.
What happens then?
Couple of options. The buyer might need to cough up more cash to cover the difference, or more commonly, the buyer and seller might need to renegotiate the price based on that lower appraisal. And that's where the inspection contingency period comes in handy for the buyer. The sources mention this period could be 3 days, could be 17 days, depends on the contract. It's your window for due diligence. If the inspection turns up major unexpected problems, or the appraisal is low, and you can't reach a new agreement with the seller on repairs or price.
You can back out.
Often, yes. The contingency usually allows the buyer to cancel the contract and get their earnest money deposit back. You'd still be out the money you paid for the inspection itself, of course, but you avoid buying a property with major unforeseen issues.
So these are really important safety nets in the process.
Definitely. They're checkpoints to make sure everyone's still on the same page and the deal is fundamentally sound before you get too far down the road.
All right, speaking of critical checkpoints, let's shift to the paperwork symphony, specifically those disclosure rules. TRID.
Tri-D, yes. Huge piece of the puzzle, especially on the lending side. Tri-D stands for TILA RESPA Integrated Disclosure. Basically, it combined and simplified disclosure requirements from 2 older laws, the Truth in Lending Act, TILA, and the Real Estate Settlement Procedures Act, RESPA.
Okay, another government acronym, but what's the point of Tri-D for, the average person listening?
Transparency, that's the core goal. It's designed to make sure you, the borrower, get clear, easy-to-understand information about your mortgage before you're locked in. It helps you understand the features, the costs, the risks involved.
And Tri-D is why we have those 2 key forms, the LE and the CD.
Exactly. The loan estimate, the LE, and later on, a closing disclosure, the CD. And these forms are central to that precision landing idea because Tri-D has really strict timing rules, non-negotiable.
Timing is everything here, isn't it?
It really dictates the pace. So the loan estimate. Your lender has to get that to you no later than 3 business days after they get your completed loan application. It's your first look at the estimated numbers.
Okay, 3 days for the LE. What about the closing disclosure?
The CD comes later.
Right.
The loan's approved and they have the final figures. That one has to be in your hands at least 3 business days before consummation. Consummation is usually your closing day, the day you officially commit to the loan.
So there's a mandatory waiting period right before the end.
Correct. A 3-day review period. And here's a little detail from the sources for buyers. That clock doesn't automatically start when the lender sends the CD. It starts when you acknowledge you've received it. So delaying that acknowledgement, that can actually push back your closing date. Checking your email and responding quickly is definitely in your best interest.
Good tip. What if something changes on that closing disclosure after you get it?
Great question, because sometimes things do change. If certain key things change, like the APR goes up significantly, or they suddenly add a prepayment penalty, or the whole loan type changes, like from fixed to adjustable, that triggers a new 3 business day waiting period.
Wow, okay. So even small changes can cause delays.
Certain significant changes, yes. It means everyone has to be really buttoned up with the numbers towards the end.
And even if you're the seller, Tri-D still affects your timeline, right?
Yeah.
Because it affects the buyer.
Absolutely. The seller isn't directly responsible for the lender's Tri-D compliance, obviously. But if the buyer's lender messes up and violates the timing rules, that can definitely delay closing, or worst case, even kill the deal if deadlines slip too much. The sources mentioned typical closing timelines are often 45 to 60 days, and these Tri-D waiting periods are a big reason why. They really set the rhythm for the final movement.
Okay, let's zoom in on the sheet music itself. What information is actually on the loan estimate and closing disclosure? They can look pretty intimidating.
They can seem that way, yeah, lots of numbers. But they're actually structured pretty logically to break down all the costs. You'll see main categories like loan costs and other costs.
What kinds of things fall under loan costs?
Yeah, those are the fees directly tied to getting the mortgage itself. Think lender origination charges, the appraisal fee, the credit report fee, maybe flood certification, things the lender requires.
And other costs.
That's a broader bucket. It includes things needed to close the deal but not paid directly to the lender. So this is where you'll see title insurance premiums both for you, the owner, and for the lender. You'll also see fees for the settlement agent or escrow company doing the closing work. The sources actually point out that you'll often see items starting with title ambler or settlement thing in this section.
I also remember seeing stuff labeled prepaids. What are those about?
Good catch. Prepaids are costs you pay at closing that actually cover expenses for a period after the closing date. Common examples are prepaid mortgage interest. That's the interest from your closing day to the end of the month.
Oh.
You'll also usually pay your first full year of homeowner's insurance up front at closing as a prepaid item. And sometimes property taxes that are due shortly after closing might get collected here too.
And then there's another escrow-related item, right? For future payments.
Yes, the initial escrow payment at closing. This is the money you put into your escrow account or impound account right at the start. It's like seed money. Your lender or loan servicer will use this account later to pay your property taxes and homeowners insurance premiums when they come due.
So it sets up that ongoing payment mechanism.
Exactly. It ensures the funds are there for those big recurring bills. And the form shows this amount even if, in some rare cases, an escrow account isn't actually being set up for your loan, it still breaks it out.
So prepaids are for the near term, right after closing. Initial escrow is for the long-term fund.
That's a good way to summarize it, yeah. Prepaids cover immediate next steps. Initial escrow seeds the ongoing account.
Are these numbers on the forms always exact to the cent? Or are they rounded?
The sources mention the rounding rules, another bit of precision. Generally, the big categories like loan costs and other costs get rounded to the nearest whole dollar. But things calculated daily, like that prepaid interest or monthly, like the initial deposits for taxes and insurance into escrow, those are usually rounded to the nearest cent. So the forms dictate exactly how precise each number needs to be.
Okay, shifting slightly closing costs in general. Who pays what, typically?
Well, both buyers and sellers have closing costs, but the sources generally agree that buyers usually pay the larger share. The average cost can vary a lot depending on where you are and the home price, but The sources cited California averages around, what was it, $7,953 with transfer taxes, or maybe $5,665 without those taxes based on average home prices there.
That's a decent chunk of change. Can the seller chip in to help the buyer with that?
Oh, yeah, absolutely. That's called seller concessions or seller credits. It's super common, especially in certain market conditions, and it can be a huge help for buyers.
Yeah.
And this is but there are limits, strict limits on how much the seller can contribute.
Limits. Why?
It's mostly to prevent artificially inflating sales prices just to cover costs, and also for the lender's risk management. The limits depend on the type of loan the buyer is getting, whether it's their primary home or an investment property, and sometimes how much they're putting down.
Can you give an example?
Sure. For conventional loans, the sources say the limit can be anywhere from 3% to 9% of the price. If you're getting a conventional loan with less than 10% down payment, the seller can only contribute up to 3% of the sales price towards your costs.
Okay.
So on, say, a $200,000 house that's a max of $6,000 the seller can give you in concessions. For VA loans, it's a bit different. There's a 4% cap on certain specific fees, but sellers can pay other things like the buyer's prepaid escrows or even the VA funding fee on top of that 4%. FHA loans have a 6% limit, and investment properties usually have the lowest limit, just 2% no matter the down payment.
You mentioned the VA funding fee. That's specific to VA loans, isn't it? How's that calculated?
It is, yeah. It's a fee most veterans pay when they use a VA loan, and it helps fund the program. It's a percentage of the loan amount. And that percentage changes based on whether you've used a VA loan before and how much, if anything, you're putting down.
So it varies.
Right. Like a first-time user putting down less than 5% pays a 2.15% funding fee. Put more down, the fee gets smaller. And the sources noted there are important exemptions too. Veterans with service-connected disabilities, for example, usually don't have to pay it. Same for Purple Heart recipients on active duty.
Gotcha. So these forms, the LE and especially the CD, they list out all these individual costs, the prepaids, the initial escrow,
Yeah.
and then they give you the bottom line, the final amount you need.
Exactly. Page 3 of the closing disclosure is where you'll find the summaries of transactions, including the crucial calculating cash to close section. It adds up everything the borrower owes, subtracts everything they've already paid, like their earnest money deposit, and boom, there's the final number you need to bring to closing, usually via cashier's check or wire transfer. And the forms also show other important stuff, like the APR annual percentage rate, which reflects the total loan cost as a yearly rate, and the TP, total interest percentage, which shows how much interest you'll pay over the whole loan term compared to the loan amount. Plus, contact info for your lender is right there too, which is handy.
It really is amazing how much vital information gets packed into those few pages. Okay, so paperwork's done, money's ready, disclosures reviewed and signed. What are the very last steps before you finally get the keys?
Right before the official closing appointment, there's usually one last thing. The final walkthrough. Super important. Don't skip this.
Why is it so crucial?
It's your absolute last chance to check the property. Make sure it's in the condition you agreed on in the contract. Verify any repairs the seller promised to make were actually done. Check that all the appliances and fixtures that were supposed to stay are still there, and make sure no new damage happened when the seller moved out. It's the final harmony check before the big finish.
Makes sense. And then the closing itself,
Ugh,
the grand finale.
that's it. The closing appointment. This is where, if you have a loan, you sign the mountain of final loan documents. Once everyone, buyer, seller, sometimes others, has signed everything they need to, the escrow holder works their magic.
The money moves.
The money moves. Your funds, the lender's funds, the payoff for the seller's old loan if they had one, it all flows through that neutral escrow account. And crucially, the actual legal transfer of ownership doesn't technically happen until the new deed and maybe the mortgage are officially recorded with the county.
Recording is the key.
Recording is the key. Once the escrow holder gets confirmation that the documents are recorded, then they release the funds. The seller gets their money, real estate agents get paid, other bills get settled, and typically that's when you, the buyer, finally get the keys. The orchestra has played its final note, the landing is complete.
That sounds smooth when you lay it out like that. But let's be real. Does it always go that smoothly? What happens if there's turbulence during that precision landing?
That's a really important point. Because no, it doesn't always go perfectly. Even with everyone trying their best, things can pop up. Issues that cause delays, or sometimes even threaten the whole deal. The sources definitely acknowledge this inevitable reality.
What kind of problems are most common? Where does the turbulence usually hit?
Financing is a big one, those financing fiascos, you could call them. Maybe the buyer's loan gets denied by underwriting right at the end, unexpected. Or that appraisal issue we talked about, value comes in low, and buyer and seller can't agree on a new price.
Right.
Sometimes the lender just needs one more document or some last-minute verification from the buyer, and it holds everything up.
So being really prepared on the finance side and staying responsive to the lender sounds critical.
Absolutely critical. Get pre-approved early, work with good, experienced loan officers and real estate agents, and jump on any document requests from your lender immediately. Good communication prevents a lot of problems.
What about other types of delays? Not just financing.
Oh yeah, delays can come from anywhere. Maybe a last-minute issue pops up with the property itself during the walkthrough, or there's a cloud on the title that needs clearing up. Sometimes it's just simple paperwork delays. Again, being prepared with your own documents and responding quickly when the escrow agent asks for something is usually the best way to keep things moving.
And what if the buyer and seller just disagree
Yeah.
about something major during escrow? Can that stop everything cold?
It definitely can. Disputes are a real possibility. One source mentioned almost 1 in 3 deals with escrow accounts face some kind of dispute. And yeah, if the escrow holder gets conflicting instructions like the buyer wants out and wants their deposit back because of an inspection issue, but the seller says, no way, you're breaking the contract, I keep the deposit, what usually happens.
The escrow agent freezes the money.
Exactly. They can't take sides, so they often have to freeze the funds in that escrow account until the buyer and seller figure it out or get a legal order.
Yikes. How do those get resolved then, if the money's locked up?
Well, the sources outline sort of a typical tiered process. Tier 1 is just negotiation. Give it maybe 30, 60 days. Buyer and seller, usually through their agents, just try to talk it out, figure out a compromise. The escrow agent provides documents but stays neutral. Works best for smaller stuff. If that doesn't work, you might move to Tier 2. Mediation. This could take another couple of months, maybe 60, 90 days. You bring in a neutral third-party mediator. Their job isn't to decide who's right, but to help both sides find a solution they can both live with. It's non-binding, so no one's forced, but it often helps preserve relationships and find common ground, especially when the disagreement is more subjective.
And if mediation fails, litigation.
Pretty much. The sources mentioned a Tier 3, likely arbitration or going to court, but didn't go into detail for this context. So yeah, it highlights why picking an escrow company that has clear procedures for handling disputes is actually really important.
Yeah, definitely something to consider. Wow. So looking back at this entire process, from that first step of opening escrow all the way to getting the keys, it really is an orchestration.
It truly is. You see how that neutral escrow holder is central, how critical the precise documents like the LE and CD are, how carefully all the costs have to be calculated and prorated, the importance of those checks like inspections and walkthroughs. Every single part has to work together.
It's really a demonstration of competence, isn't it? Coordination, meticulous attention to detail, all needed to bring the deal home successfully. And hopefully, understanding this helps you, the listener, feel more empowered whether you're buying or selling.
Exactly. A smooth closing doesn't just happen by accident. It's the result of this intricate process being executed well. That's how the conductor leads the orchestra to that satisfying final chord, happy clients, people achieving their real estate goals.
Absolutely. Which leaves us with a final thought to chew on. When you consider just how complex this whole thing is, how many different people are involved, buyers, sellers, multiple agents, lenders, appraisers, inspectors, title folks, the escrow holder.
It's a lot of moving parts.
Right. And you factor in the potential for just honest mistakes, human error, plus those sophisticated scams we talked about, like the attacks on escrow companies. Does the success of this whole system ultimately depend more on the strength of the procedures, the rules, the detailed paperwork? Or does it rely more fundamentally on the basic trustworthiness and the diligence of every single individual person playing their part in that orchestration?